Good morning and welcome to today's conference hosted by the Wharton School's Jacobs Levy Equity Management Center for Quantitative Financial Research. We're so pleased to be back together in person for the conference today for the first time since fall 2019. We have an excellent lineup today of research and speakers.
As Chris said, Bruce and Ken's vision has made it possible for Wharton to expand its commitment to research and scholarship in quantitative finance through the Jacobs Levy Center and the Wharton-Jacobs Levy Prize.
It is an honor for me to be here with you today and to welcome you all back in person to the Jacobs Levy Center Conference, bringing faculty, students, and financial practitioners together to learn about and discuss the latest research in quantitative finance.
Frontiers in quantitative finance may, for many, describe exciting, cutting-edge additions to our empirical toolkit. And indeed, you will hear presentations today that harness these scientific advances in innovative ways.
We try to add something to this large literature by examining the role of private and public information for theories of momentum and reversal.
It is a truly fascinating paper that offers a fresh look at momentum.
The Jacobs Levy Center Research Paper Prizes were established in 2014 to recognize outstanding scholarship in quantitative financial research.
We invite the authors of the winning papers who are here today with us to join us on the podium to accept their awards. Congratulations.
We're going to use a broad set of public and firm-specific signals. We're going to do rolling regressions to predict out-of-sample returns. We're going to do this using both machine learning methods and linear regression methods.
Let's look at this table. For a lot of you, it looks like a table. But to me, actually, it looks like a beautiful picture of Van Gogh.
I hope we can make this as fun a panel as possible and perhaps a little bit controversial. But let me just start with something that seems pretty basic, which is how do you each define momentum?
Investors look around and say, I don't trust this. But then as more and more information is revealed consistent with that price rise, the price continues to increase. My sense is that that might be a lot of what's driving momentum.
It's not easy to arbitrage away. All three of us have lived through multiple momentum crashes. They're painful. They're rare. They're deep. They cause people to give up, which is exactly what you need if you're going to stay in it.
What's interesting to me as an investor is, are there predictabilities in returns that we can use to improve performance? And then secondly, are there ways to do performance evaluation to better explain manager performance and distinguish between luck and skill?
This is basically 30 years, professor, after your original research, but maybe the central premise, in days like today, years like 2022, is it still stocks for the long run?
It's remarkably durable, and then we also know it's remarkably volatile in the short run, but the durability of the equity or equity premium, as you might say, although then you have to subtract what you think about bonds, is really quite remarkable.
It seems that modern machine learning has taken this principle of parsimony and essentially turned it on its head. So what I want to talk to you about today in particular is that this is also happening in finance.
And what this paper does is this paper basically comes into this literature and looks at an application for portfolio choice, specifically an application for timing.
So we now have the great pleasure of presenting the 2021 Wharton-Jacobs Levy Prize for Quantitative Financial Innovation. We are delighted to have the 2021 winners, Narasimhan Jagadish and Sheridan Tipman, with us here in person to accept their award for their research on momentum investing.
Their 93 Journal of Finance paper, Returns to Buying Winners and Selling Losers, Implications for Stock Market Efficiency, was a direct challenge to the conventional investing approach of buy low, sell high.
So whatever you believe explains the momentum effect, we are grateful to our honorees for their meticulous research that gave new life to this factor, which allows investors to harness it.
By shining a bright light on classical beliefs about how markets work, they have challenged us and themselves to gain a deeper understanding of stock price behavior so that our theories better reflect market realities. Please join us for the presentation of the prize medals.
Thank you very much. It's indeed a great honor to receive this award. A picture of us taken a little after this paper was published. Okay? So as you can tell, a lot of time has passed, but fortunately, the paper aged better than its authors.
One thing that I think about when I think about this paper, I go back to the old joke on the economist seeing the $20 bill on the sidewalk and sort of walking by and saying, you know, that's obviously not a real $20 bill, otherwise someone would have already picked it up.
Thank you again for attending. We'll look forward to seeing you at our further and subsequent events and hope you remain in touch with the center. Great to be with you folks. Enjoy the day.